Welcome to this deep dive. Today we're going to be tackling the Canadian government's fall economic statement for 2024. It's not exactly a light read, but don't worry, we'll break it down and pull out the juiciest bits for you.
Sounds delicious.
You've probably noticed the Canadian economy has been facing some serious challenges over the past few years: pandemics, global conflicts, and inflation, just to name a few.
Yeah, it's been a wild ride for everyone.
But here's the big question. How is Canada doing NOW in late 2024? That's what we're here to figure out. Expert speaker, are you ready to dive into some economic data and decode the government's plans?
Absolutely. What's fascinating here is how Canada seems to have achieved something. Many economists considered almost impossible a soft landing for their economy.
Okay, imagine walking a tightrope. That's what the Canadian economy's been doing. The report uses the term soft landing a lot, basically meaning they managed to avoid a recession even with all the global turmoil. How did they pull that off?
It wasn't magic,
Hmm.
but it was a delicate balancing act. Their fiscal policies played a big role. They controlled spending while also supporting the Bank of Canada's moves to curb inflation, all without causing massive job losses.
So it's like they tapped the brakes just enough to slow things down without slamming into a wall.
That's a great analogy. And the report highlights Canada's impressive fiscal discipline. They have the lowest deficit to GDP ratio in the G7, tied with Germany.
Okay, so for those of us who aren't economists, what does that actually mean? Why should we care about this ratio?
Think of it this way. The deficit is like the amount of money you borrow on your credit card each year, and GDP is like your annual income. A low deficit to GDP ratio means you're not racking up debt faster than you're earning money.
So it's kind of like living within your means on a national scale.
Exactly. It's a sign of responsible financial management.
So Canada's basically got its financial house in order. That's got to be good news for investors, right?
Absolutely. It makes Canada look like a safe and stable place to invest, especially in times of global uncertainty.
It's like a beacon of stability in a stormy sea.
Exactly. But even though they avoided a recession, the report also mentions that it's been a painful journey.
That makes me think of a bumpy plane landing. You're relieved to be on the ground, but you're still a bit shaken up. So what's been painful about this soft landing for everyday Canadians?
Well, the high interest rates used to combat inflation have hit consumers and businesses pretty hard. Even without a full-blown recession, those high rates squeeze budgets and make it harder for businesses to invest and grow.
So even though they stuck the landing, there's still some turbulence for people trying to make ends meet.
Yes, it's important to acknowledge that even with positive economic indicators, many people are still feeling the pinch.
It's like a delayed reaction, kind of. You brace for impact, but the real pain comes later.
Yeah, that's a good way to put it.
Okay, enough metaphors. Let's crunch some numbers. The report is packed with charts and data, so let's focus on the most important takeaways.
Sounds good. Let's start with GDP growth. Canada's economy has bounced back from the pandemic recession faster than any previous recession. It's also recovered faster than other G7 nations.
Wow, that's impressive. Chart 5 really shows the difference visually. It's like Canada hit the fast forward button on recovery.
Exactly. And the IMF projects that Canada will lead the G7 in GDP growth in 2025 too. You can see that in chart 2.
So they're not just catching up, they're pulling ahead.
That's right.
Now let's talk about inflation, which has been a major concern globally.
Sure.
Yeah, it feels like grocery prices have been on a roller coaster ride the past few years. But the report says Canada has kept inflation within Bank of Canada's target range all year. That's a big win, right?
It's a huge GE win. Imagine having a thermostat for the economy. The Bank of Canada wants to keep inflation at a comfortable level. Not too hot, not too cold. And they've managed to do just that.
I definitely prefer a comfortable economy to a scorching one. And I saw that grocery inflation specifically went down dramatically, from a whopping 11.4% in January 2023 to just 2.7% in October 2024. That's a big sigh of relief for grocery bills.
Absolutely. Chart 12 shows that decline. And it's a tangible sign that inflation is cooling down.
So no more sticker shock at the supermarket.
Hopefully not. Another important point is that Canada achieved lower cumulative inflation from 2019 to 2024 than both the UK and the US. They weathered the inflation storm better, so to speak.
So Canada's like the inflation whisperer, taming the beast better than anyone else.
It seems that way. Now let's talk about a concept called core inflation. Imagine peeling back the layers of an onion. Core inflation strips out the volatile things, like food and energy prices, to get a clearer picture of underlying price trends.
So it's like getting to the heart of the matter, seeing if inflation is really baked into the economy or just a temporary blip.
That's a great way to put it. And the data suggests that inflation is becoming more manageable.
That's reassuring. Now, what about those interest rates we talked about earlier? The report says Canada has been leading the G7 in cutting them.
Right.
That's good news, right? Because high interest rates make everything from mortgages to car loans more expensive. So, what does this mean for people on the ground?
It's like a shot of adrenaline for the economy. Lower interest rates mean lower borrowing costs for everyone. It encourages people to spend and businesses to invest, which helps to stimulate economic growth.
So, it's like loosening the reins a bit, letting the economy gallop a little faster.
Exactly.
And speaking of things moving in the right direction, let's talk about wages. The report says real wages, that's wages adjusted for inflation, are up 5% since pre-pandemic levels, and they've been outpacing inflation for 21 months straight.
That's fantastic news.
It means people's paychecks are actually gaining buying power, not just desperately trying to keep up with rising prices. That's a huge boost to living standards.
It is. Imagine having 21 months where your paychecks are actually gaining ground. That means Canadians have more money to spend, save, and invest, which creates a positive cycle for the economy.
It's like a virtuous circle where rising wages lead to more spending, which leads to more economic growth and so on. And it's a stark contrast to the U.S., where charts 17 and 18 show that median weekly earnings have only increased by 3.4% over the same period. Canada's clearly pulling ahead in this regard.
They are, but there's one area where they're still facing a major challenge: housing affordability.
Yeah, that's been a hot topic in Canada for years. Is there any good news on that front?
While overall affordability remains a significant issue, there are some glimmers of hope. Asking rents for new leases are actually declining in many markets.
So it's like a tiny crack in the dam, maybe a sign that the pressure is starting to ease.
Possibly. The report highlights Toronto and Vancouver specifically, with drops of 9.4% and 8.9% respectively.
Mm.
As you can see in Chart 13, it's a small step, but it suggests the market might be starting to cool down.
Okay, so we've got a pretty good snapshot of where Canada stands economically. They managed a soft landing inflation, its cooling wages are rising, but housing affordability is still a major concern. Now, what's the government actively doing to address these issues and chart a course for the future? What are their top priorities?
The Fall Economic Statement outlines 4 key pillars that we can think of as their game plan: equipping Canadians for success, investing in innovation, navigating geopolitical risks, and leading the clean energy transition.
Okay, let's unpack those pillars one by one. Starting with equipping Canadians for success. What does that even mean? Are they handing out tool belts?
Not quite, though. That's a fun image.
Okay.
It's about investing in social safety nets, things that reduce costs for everyday Canadians and empower them to participate in the workforce.
So things like the $10 a day childcare program, we touched on it earlier, but the report really emphasizes its impact.
It's been transformative. Chart 22 shows a 28% decrease in childcare costs since the program rolled out. And Chart 23 shows a nearly 4% increase in workforce participation for women with young children. It's not just about affordability, it's about unlocking potential.
It's like removing a major barrier, allowing more people to enter or re-enter the workforce. And the report says this program could even lead to a long-term GDP boost of 1.1%. That's pretty remarkable. What else falls under this pillar?
This pillar also includes free dental care and prescription medications. Think about it. When people aren't crippled by healthcare costs, they can focus on work, contribute to the economy, and improve their overall well-being. It's a win-win.
Okay, so pillar 1 is all about empowering people. Now let's move on to pillar 2, investing in innovation. What's the focus here? Flying cars, teleportation.
Tempting, but not quite. While those would be exciting, the focus is on more immediate, yet equally transformative technologies, specifically AI. The government wants to secure Canada's AI advantage, and they're putting serious money where their mouth is: nearly $5 billion invested.
Wow, that's a lot of digital brain power. What exactly are they doing with all that investment?
It's a multi-pronged approach. They're attracting top talent, incentivizing research, and supporting AI adoption in key sectors. It's about building a robust AI ecosystem in Canada.
Smart move. AI is going to impact pretty much every industry, so it makes sense to be at the forefront of that wave. But it's not just about throwing money at AI, right?
Exactly. This fall economic statement also includes some savvy tax incentives. They're extending something called the Accelerated Investment Incentive and making the scientific research and experimental development tax credit more generous.
Okay, those are some pretty jargony terms. Can you break those down for us non-economists? What do those incentives actually do?
Essentially, they're making it more financially attractive for businesses to invest in innovation and R&D in Canada. It's like giving them a little extra nudge to take risks and develop new technologies.
So it's like planting seeds for future economic growth.
Exactly. And speaking of the future, let's move on to pillars 3 and 4, which address some pretty big challenges: navigating geopolitical risks and leading the clean energy transition.
Okay, those sound pretty timely given all the global uncertainty we're facing. Let's start with Pillar 3. What's the game plan for navigating those geopolitical risks?
The report emphasizes the need to strengthen trade relationships with trusted allies. Basically, they want to diversify their trade portfolio and not be overly reliant on any one nation. They're also laser-focused on ensuring supply chain resilience, which, as we've all learned, is crucial in a world full of disruptions.
Yeah, the pandemic really exposed how fragile global supply chains can be. It's like realizing you've built your house on sand. So who are these trusted allies Canada is looking to buddy up with?
While the report doesn't name specific countries, it's heavily implied that they're aiming to counterbalance their reliance on China. There's also focus on countering U.S. tariffs and protecting Canadian economic interests. In a shifting global landscape, it's a delicate dance balancing cooperation and competition.
It's definitely a complicated world out there. And speaking of complicated, let's move on to Pillar 4. Leading the clean energy transition. Is Canada trying to become some sort of eco-superpower?
In a way, yes. They're investing heavily in clean energy and decarbonizing technologies. With the goal of becoming a global leader in this space, think wind farms, solar power, green hydrogen, all that good stuff.
Sounds ambitious. How much are they actually spending on this clean energy push?
A lot, Doc. The report mentions a whopping $94 billion in tax credits, designed specifically to attract investment and create jobs in the clean energy sector.
Wow, that's a serious commitment. What's the rationale behind such a massive investment?
It's a convergence of factors. First, the increasing global demand for power, especially with the rise of AI and other energy-hungry technologies. Second, the urgent need to transition away from fossil fuels to address climate change. And third, the economic opportunity of becoming a leader in a rapidly growing industry.
So they're trying to be both environmentally responsible and economically savvy.
Exactly. It's a smart strategy, and it seems to be attracting a lot of attention.
That's great, but even with all that government spending, they'll need private investment too, right? What's their strategy for attracting capital?
That's a great point, and it's where their economic success really shines through. Canada is actually attracting the most foreign direct investment per capita among all G7 nations. Chart 29 really highlights that achievement.
Whoa, that's impressive. What kind of investments are we talking about here?
It's a mix of established industries and cutting-edge sectors. For example, Honda is investing $15 billion to create Canada's first comprehensive EV supply chain, right in Ontario.
So they're not just talking the talk, they're walking the walk.
Exactly. And Volkswagen is dropping $7 billion to build their first overseas EV battery plant in St. Thomas, Ontario. Those are just two examples among many.
Sounds like Canada is becoming an EV hub.
Yeah.
And the report mentions some other big names too. BHP investing $14 billion in a low-emissions potash mine in Saskatchewan, and a joint venture by Stellantis and LG Energy Solution putting over $5 billion into an EV battery facility in Windsor, Ontario. It's clear they're attracting serious players in key industries.
And it's not just big-ticket items. They're also seeing strong capital expenditure intentions, especially in net zero sectors, according to Chart 30. Even small businesses are feeling optimistic with their confidence levels approaching historical averages. This points to a healthy and diverse investment landscape.
So Canada's got a lot going for it. Government investment, private capital pouring in, and a focus on future-proof industries. But there's this interesting tidbit in the report about the Canadian dollar becoming more important on the global stage. Explain that to me like I'm 5, because economics isn't exactly my forte.
All right. Imagine the world's currencies are playing a game of popularity. The Canadian dollar just got voted most likely to succeed. In 2023, it became the world's 5th largest reserve currency, zooming past the Chinese renminbi. You can see that climb in Chart 32.
Okay, so it's winning the popularity contest. But what does that actually mean?
Well, a reserve currency is like the cool kid everyone wants to hang out with. Countries hold them because they're stable and reliable. And for Canada, it brings perks: lower interest rates, easier access to capital, increased demand for Canadian bonds. It's a signal of trust and confidence in their economy.
So Canada's basically the valedictorian of the global economy right now. Brains, popularity, A&D, a good heart with all that social spending. But even valedictorians have challenges. And the report definitely talks about recalibrating immigration. Why is that a priority and what's the plan?
You're right, no economy is perfect. And one of Canada's challenges is housing affordability. That's where immigration comes in. They've decided to pause the strong population growth for 2 years via their 2025-2027 immigration levels plan. Chart 36 shows how that looks.
So they're tapping the brakes on immigration. Seems counterintuitive for a country that prides itself on welcoming newcomers.
It's not about closing the door, it's about managing the pace. By slowing population growth, they're aiming to ease the pressure on the housing market. Less demand means supply can catch up, hopefully leading to more affordable housing.
Makes sense. But won't slowing immigration hurt the economy?
It's a calculated risk, and the government believes the benefits outweigh the drawbacks. They project that this pause could actually reduce the housing supply gap by a whopping 45% by 2030.
Wow, that's a significant impact.
It is, and it's not just about housing. This pause is also expected to lead to faster GDP per capita growth, lower unemployment, especially among youth and newcomers, and better alignment between the number of workers and available jobs. It's about finding a sustainable balance.
Okay, so it's a strategic pause, not a permanent shift. That's reassuring. Phew, we've covered a lot of ground here. Expert speaker from all this data and analysis. What's your overall takeaway?